Hi, my name is Kevin Retcher, and in this video we're going to go through two topics. One is VA funding fees, what they are and what they do, and how to actually save some money on those, and how to use that for your advantage. And two, VA loan eligibility per county limits, what you're able to buy, and what you're able to buy if in fact you have an outstanding VA loan or that you have another house elsewhere. How to actually figure out what and how much VA eligibility you actually have remaining to potentially buy in any given area. So we're going to walk you through that. So in the first scenario, let's talk about the VA funding fee and what it is. VA funding fee is a fee that is added on top of the loan as a percentage. This VA fee goes to the VA to run this program and help with the cost at the VA administration and their budget. Okay, everyone's required to pay a VA funding fee unless you're exempt. What does that VA funding fee actually do? That VA funding or that VA loan guarantees the lender 25 cents on the dollar if you default on the loan for any reason. So that gives that loan a guarantee for lenders. They're more apt to do VA loans simply because they have that guarantee. Typically, you get a better interest rate on a VA loan. Typically, the spread is 3/8 per 1% versus a conventional is normally a quarter for every 1% in price. So VAs are definitely one of the best loans out there. They also don't carry any mortgage insurance. So that guarantee, if you think about it in the sense of mortgage insurance, on a conventional loan, you wouldn't have mortgage insurance if you put 20% down. This VA guarantees 25% to the lender. So it actually has an extra 5% more of a guarantee than what if someone put 20% down on a conventional loan. So that's why it's so well liked in mortgage-backed security world. So let's get into the cost of that. If you're a first-time user, it is 2.15%. If you're a second-time user, it's 3.3%. And then if you're exempt, of course, it's 0. What does that mean? If it's 2.15% on a $100,000 loan, you would then that financing fee gets added on top of that, and your loan amount would be $102,150. Likewise, if it was 3.3%, your loan amount would be $103,300. Okay, so if you multiply that times the cost of housing, in like Fairfax, if you were buying $1 million home and you were subsequent use at 3.3%, you would have a loan amount of $1,033,000. So it would add $33,000 to your loan amount, which is a lot of money. So how can we mitigate some of that potentially? So let's look at that scenario a little bit more. A $1 million loan, 3.3% subsequent use. Your loan amount would be $1,033,000. If you put $50,000 down on that $1 million loan and you did a loan amount of $950,000, your funding fee would drop to 1.5% of that amount. So the funding fee would only be $14,250 versus $33,000. So by putting that $50,000 down, your funding fee that got added on top of the loan just got reduced by over $18,000. So putting 50 down, you gained another 18. Essentially, loan amount on that would be $964,250 in that particular scenario. So let's get into loan limits. I heard the other day one of my Good realtors that I use on a regular basis say that he was referring to loan limits for the VA loan at the county level. That only applies if you have an outstanding VA loan elsewhere. If you have full eligibility, as of 2020, you do not have a loan limit when it comes to buying VA. You could do a $2 million 0% down VA loan provided that you qualify, okay? So keep that in mind. If you have a house in North Carolina and you're looking to buy here in Washington, D.C., then you then have to figure out how much eligibility you have, and county loan limits do come into play. So let's go through one of those scenarios. Recent client was coming to the Pentagon. So now we have to figure out what our local loan limit is. In our area, we have what's called bonus entitlement. Fairfax County loan limit is $1,149,825. So the VA, remember, guarantees 25 cents on the dollar, so you multiply that by 0.25, and you get what the eligibility amount for a veteran is, which is $287,456 of loan guarantee. That's how much the VA is willing to back you on, you not defaulting on a mortgage. That's pretty impressive that you have that because of your eligibility and your time that you were in the service. Most counties throughout the country are 766,550 is their county limit. And so divide that, multiply by 0.25, and that would be 191,637. So we do need to keep in mind both of these numbers in the scenarios that we're going to go through going forward. So let's look into scenario number one. So what happens if there's a partial entitlement already charged? So in this scenario, we have a client. He is moving to Washington, D.C. He currently has an entitlement charged in Florida for $43,771, and he bought another house a year later in Louisiana and charged $49.50 toward his entitlement. So he's used $93,271 of his entitlement. Now keep in mind, we just did the math above. That math is that he's allowed up to $287,000 toward his eligibility. So we subtract that $193,271 from there, and that means he has remaining $194,185 remaining, okay? Because he has that remaining and he's moving to a high-cost area, he can then buy a third property. Yes, a third VA loan. And if you multiply that by 4, he would have $776,741 available to buy with zero money down. So yes, you can have more than one property, and here's let's just walk through that real fast. 3.3 subsequent use. He's got 194, 181 left. Multiply that by 4, and he has a guarantee amount of $776,741, VA funding fee on top of that, and then his loan amount would be $802. So what happens if this person wants to buy more than that $776,741? Can he do that? The answer is yes. How that's done is basically, think of it as this, is the veteran then has to put up 25 cents on the dollar for every bit that is above the entitlement that he has remaining. And so we can kind of walk through those numbers. Let's look at this scenario. He wants to buy, same guy, wants to buy $1 million property. Can he do it? Absolutely. He has to contribute 25%. So let's look at the math here. So $1 million purchase, he's got 776, 741 available, equals the difference of 233, 259. Multiply that by 25%, and he needs to have 55,815 is what his portion of the 223 that's over and above the 776. So let's look at it on the calculator basis. $1 million loan, 25% guarantee on that. So to get a VA guarantee, they need $250,000 of guarantee on this specific loan. He only has 194 remaining. And so they just take that 250 minus the 194 equals the 55,815. So keep in mind, he gets an added benefit here by putting down that 55,000. That's more than 5%. So his VA funding fee on this deal drops to 1.5%, versus if you looked at that above deal, at 776, his VA funding fee was 25,000. So he actually saved money. This is an example of where that 5% actually is working in your favor. So let's get into scenario number 2. We have a person that is already at the Pentagon, buys a house here in a more higher cost area, and then he's going to move to Cumberland County in North Carolina, Pope Air Force Base. Okay, so in that scenario, this person has used 171,736 of his entitlement. So if we look at the math on that, keep in mind when he's going to a lower cost area and he has an outstanding eligibility, it goes by the county that he's moving to. Cumberland would not have bonus entitlement, so his actual entitlement going there is 191,637 max eligible on the basis of what he's allowed to have outstanding. So if he keeps the house here in the DC area because he might be moving back to this area, PCSing, or wants to come back here after he retires and gets a government job, and he wants to move back into the home, his current entitlement in Washington was 171,736. So in that particular situation, he would only have remaining the 191 minus the 171, he'd have 19,901 left over. So the max house he is able to buy is 79,606, which is the 19,901 times 4, okay? Let's look at the scenario. So let's say he moved down there and wanted to buy a house for $400,000. Could he go VA? He can. He's got 19,901 eligibility left. If it was a $400,000 house, he would need to have 100,000 in total eligibility. So you would subtract off what he has left over, and he would then be required to put down $80,099 down payment to get a VA loan. So if he was buying a $400,000 house and had $80,000, most likely he probably wouldn't use a VA loan in that instance. he would just put 20% down and go conventional. So keeping your VA status on a house, you have to weigh those options on whether or not it makes sense. If he did, if someone didn't convince him to go conventional and he just went VA and left $19,000 eligibility down at Pope's Air Force Base and then got transferred out to California, sold his house here, he still wouldn't be able to buy unlimited amount out in California because of the house left back in North Carolina. So you don't want to leave remaining eligibility in low-cost areas. It can come back to haunt you or hurt you, okay? So when you get equity in those homes enough to refinance, you might want to refinance to a conventional loan once you're out of mortgage insurance and if it makes financial sense for you, okay? But the VA loan itself, it's full eligibility, allows you to buy any size home anywhere you want as long as you have that full status. So in closing, we went over two main topics here: what the VA funding fee is, what it does, how much it is for first-time use, subsequent use, and how to mitigate some of that. And we also went into loan limits. There are no loan limits if you have your full eligibility. And then we went into if you do have an outstanding eligibility in another state, how that impacts you coming into a high-cost area, and how it impacts you when you have something in a high-cost area and you move to a standard area. If you have any questions on any of that, my name is Kevin Retcher. My phone number is 703-799-5626. And to all the Marines out there, Semper Fi. you have a house in North Carolina and you're looking to buy here in Washington, D.C., then you then have to figure out how much eligibility you have, and county loan limits do come into play. So let's go through one of those scenarios. Recent client was coming to the Pentagon. So now we have to figure out what our local loan limit is. In our area, we have what's called bonus entitlement. Fairfax County loan limit is $1,149,825. So the VA, remember, guarantees 25 cents on the dollar, so you multiply that by 0.25, and you get what the eligibility amount for a veteran is, which is $287,456 of loan guarantee. That's how much the VA is willing to back you on, you not defaulting on a mortgage. That's pretty impressive that you have that because of your eligibility and your time that you were in the service. Most counties throughout the country are 766,550 is their county limit. And so divide that, multiply by 0.25, and that would be 191,637. So we do need to keep in mind both of these numbers in the scenarios that we're going to go through going forward. So scenario number one that I want to walk you through. Scenario number one I want to walk you through. So what happens if there is an entitlement that's already charged, okay? So in this particular situation, we have a client coming to the Pentagon. He already has a loan, as you can see here, in Florida and in Louisiana. And his entitlement that's charged already is $93,271. So let's look at how that comes into play.